Breaking news, potentially 50% of the staff at the FHA, the Federal Housing Authority, just got their jobs axed. And that's on top of other job cuts at Housing and Urban Development, HUD. Why is that so important? Well, that is where the vast majority of mortgages, single-family home and multifamily, they're all coming from. So that has a big impact on the housing market, multifamily sector. So much to cover on today's Gray Report. Research reports from CBRE, Wall Street Journal, Newmark, RealPage, John Burns, research consultant, BizNow, National Association of Home Builders. If you are at all involved in the multifamily space, you're an investor, you're an LP making passive investments, maybe you're an institutional investor making investments for clients, or you're right in the trenches with us, you're a syndicator, you're working in property management, you're in the right spot. We're talking about all of the stories that you should have some depth of understanding on. They're happening right now. There's so much in the world that's changing. There's a lot of noise. There's a lot of chaos, whether it's coming from politics, internationally, tariffs, Trump, you name it, but you got to get the multifamily facts straight because the fundamentals are pretty clear. A lot of things are moving around. A lot of noise. Let's separate the signal from the noise, get clear, arm you with some really good information so you can make some very well-informed decisions in your investments and your career. Dr. Matt Bosnagel has joined us once again. An incredible lineup. You're going to stick around and watch the whole episode and make sure you subscribe, like this video. Let's get into it. Welcome back to the Gray Report. Matt, how are we doing today?
Pretty good. It's been an interesting week. It has been, it seems like things are really changing, really getting weird.
Yeah, it's a lot of noise. Like I was just saying, it's a lot of noise, a lot of uncertainty, and it's from every different angle, every different direction. And, you know, that state of uncertainty doesn't lead to a lot of clear decision making. In fact, and we saw this, Matt, back in 2022 and 2023 when interest rates were rising and potential recession, and it's hard to make any long-term plans or make any long-term decisions when you're uncertain over the next 6 months, a year, a couple of years, because you're like, hey, I'm not going to make a big bet right now. It could go the other way. I thought I was confident. I'm just not confident in anything anymore. And I mentioned this a couple times just around the office this week and last week, but it doesn't matter your politics. It doesn't matter, for Trump, not against Trump. The reality is there's a lot of things that are changing right now. Again, whether it's geopolitically, talking about Europe and Russia and all of that, to the federal government and just our relation to the federal government and services, and it is everything from ideological to personal to and everything in between. It's just whatever your vision of how the world worked is, maybe you're having to readjust of how it might work in the future. And that on top of that, we've got the reality is there are multifamily deals out there that aren't doing that well. Some are just doing just awesome, crushing it. But, we're having conversations with multifamily investors every single day. I think, we're having about 10 different calls today. You would not believe the amount of capital calls people are going through right now.
I know that. Just anecdotal. It's almost like they want me to hear this. It's because fortunately this is not an experience that we have had.
Never had an issue with capital call.
But to hear them, it's like, really? Well, I mean, I was just surprised.
We're seeing some new, preferred equity funds being launched from sponsors who, raising capital for their own deals, deciding not to do a capital call, raising another fund that's going to go in front of their original investors, and which you got.
It's a dramatic thing. That's pretty dramatic. Some of the idea that these capital calls are happening, period, at least our sample size is small, but the fact that we're running into these same things when before. Nary a peep in terms of that. That did not happen. And we have regular raises where we pretty much check in on these investors. And I don't think that was not the theme of previous raises. It never happened. It wasn't an issue. Yeah.
I mean, capital calls prior to the last few years were pretty few and far between. I mean,
it's not impossible.
No, it's not possible, but it's, it's less than 10% of all the deals. Maybe it's 5% of the deals. Okay. I mean, there are certain investments, like if you invest in a fund, there are planned capital calls because it's like you don't need to contribute all the money because we're not going to spend all the money right away. So like there are times where like, or we're not going to call your capitals, we're not going to make that investment, or we're not going to do that project. So we're going to have you hold on to your money, and it helps with the the total return. And anyway, but capital calls, they happened every once in a while, but it was specific deals. But we're having conversations especially with high net worth, ultra high net worth, LP investors. We call retail because they're not like a institutional family office or RIA or something. Mm-hmm. But the active LPs who've been loving the multifamily sector for the last 5 years or so, if you've been pretty active and you've diversified across sponsors, which is pretty good practice that I've talked about in the past, there's a good chance you're facing a capital call. Yeah. And again, we're having these conversations, and it's not like one. It's like someone's done 20 deals in the last couple of years, and there's 25% of them are having capital calls issued, or even more. Yeah. And so we've had a lot of cases where folks wanted to invest in the deal that we have, Walcott Apartments, for accredited investors only. You can check it out on our website. But they can't. They're deciding between do I meet this capital call? Yeah. Or do I make a new investment? And it's a question of good money after bad. Yeah. Does that additional investment save your original investment? Yeah. Or will you never get any of that back? The first $100,000 is gone. Sending another 50 doesn't get the 100 back. Now you're down 150. Yeah. So is it better to take that 50 and put into a deal where you can hopefully 2x and get to 100, and then you're at least back to square one? That's the judgment call that people are making, and it's hard because the sponsor that they invested with, usually they like the person or the individual or the company. They don't. That's why they invested in the first place, is they liked them and they trusted them, and they may even think that they were doing a good job, but they got caught up in the times in the market, and they tried everything they could, and I don't want to let them down. I don't want to disappoint them. Yeah. And I've even heard cases of sponsors, where LPs kind of being intimidated by their sponsor. In which it's like that. I think that should be the other way around. I think isn't the sponsor working for the investor?
It's good to be scared of your investor or a little bit. You meet their expectations.
Well, I want to be able to deliver. I want to deliver.
I
don't want to disappoint.
Don't want to boss them around.
I don't want to disappoint anybody. I want to over deliver and do what we said we were going to do, and I don't want to let anybody down. I think that's how most people in the space operate generally. Just sometimes things don't work out, but there's. On the other side, it's like we're seeing an incredible amount of rental demand. The pent-up demand to acquire multifamily assets is palpable. But the problem, it's all high quality. The potential capital inflows for high quality apartments is massive right now. Yeah, interest rates aren't allowing a lot of those transactions to take place. The far between ones that make sense, like Walcott that we've got picked up, it's just there's not many opportunities out there. We got it something off market, and we weren't even the higher bidder. They knew that we could close. So it's an interesting time, a lot of uncertainty. But I think the point of this show, what we do every week, Matt, is trying to again clarify a little bit, and I said in the intro, take all this noisy signal, and see what we can do to filter it out and get a little bit of reality. So let's start us with that. Help us understand how to make sense of this multifamily market. Record high deliveries, record low starts, record demand, record new supply, negative rent growth in some markets, slightly positive in others, population growth, but tariffs, immigration, make sense of it for me.
I think that the politics, which we'll mention a little later, is that's a big uncertainty. And I think you talked about future, like people don't know what to expect. People know what the future is. Right now, it seems like it's nothing dramatic has happened, or the impact hasn't yet been felt. But that's a big question mark. Other than that, though, apartments fundamentals, great. They're great. There's several reports here, several data sources that are talking about whether it's household formation or apartment rent, apartment absorption, demand. That's going to really help the multifamily market come into balance. It's not going to mean that rents skyrocket, but they will come into balance. And how this is way different than 2023 or I'm sorry, the beginning of 2024 is that the market was a lot softer, a lot more shaky. The expense growth was still like a big problem. Now expense growth is still a problem, but it's less of a problem now than it was.
The hard part is, that the psychology can drive the market sometimes more than the fundamentals.
Yeah.
At least in the short term. But so understanding the long term, let's just fast forward on the docket. Let's try to break through. Where do the fundamentals come into play? Let's first focus on the fundamentals, and then let's get to all the periphery.
Yeah.
Some of it's closer than the periphery than others, but
and I think that you nailed down what I really think is the most important takeaway for this discussion. The stuff that is real is a little bit more compelling. The stuff that we know and have clarity over is more compelling, I think, and is going to be a more powerful force than the uncertainties that may be at the periphery.
So we've got a new article out from the Wall Street Journal. There's obviously more, industry niche sources that we often cover, but we always like covering these Wall Street Journal pieces because it's what more folks are reading, and it can give a little, again, getting that psychology. This might not have all the nuance, but it certainly is going to be part of the mainstream narrative. According to Wall Street Journal, we're headed toward a landlord-friendly era. Expect higher rent prices. The prospect of rising apartment rents could further stoke inflation and give the Fed another reason to pause. So let's not focus on the Fed pausing right now, because don't we still need to get into like a little bit of negative?
I know
on CPI. We're just starting the slowdown. Shouldn't that take place? I'm just talking about CPI, and I said we were going to not talk about inflation right now, but there should be a period of slow rent growth in CPI, of owner's equivalent of rent.
Yeah.
Anyway, break the Wall Street Journal article down for us, Matt. What's everyone else
and
here?
You've alluded to this too, and it's something that we've discussed ad nauseum. Not as much lately, but if this was in mid 2023, it would probably be covered in the Gray Report. The fact is, the BLS, the Consumer Price Index measured rent growth. When the Consumer Price Index measures it, that is the past. That's a lagging indicator. And right now, market rent growth for new apartments, this rent growth is like near zero, maybe a little negative.
That's what I'm saying. We haven't even gotten to national, like barely positive. It's zero. So and it's lagging, and the lag is longer than we thought it was. We thought it was going to be 12 to 18 months. It seems like it's more of like 18 to 24 months. And rents have been negative or have been negative to zero for almost like 18 months. So shouldn't we have more than a year-long period of suppressed shelter costs in CPI?
I think so.
Or that's just not how it works.
Well, but I think that the other thing about the BLS numbers for rent growth is they're not as spiky. So when rent spiked, the BLS numbers didn't spike as much. Rent was it's like 18%.
I know it's going to take a long time to come down, but doesn't that slope doesn't that take a while?
It hasn't.
What's being suggested is it's just going to keep going.
Yeah, no, you're right. And where it spiked and then it went under, so it was above average and then where is it going to be below average? It's still not necessarily below average at the moment. Yeah. So I think that there's a lot more cushion when they're talking about that. They shouldn't really bring up BLS because I'm fairly confident that that rent growth as measured by BLS will continue to go down. It's just the way it works. It's not really connected to reality. The other things that they talk about, apartment construction, this is like physical reality, is a lot more relevant to their argument. And they make another thing that we've talked about before. Builders aren't building buildings anymore, or at least as much as they wanted to or were doing, a year and a half ago.
Yeah, I don't think I saw a quote today. I think it was somewhere on LinkedIn that there hasn't been such a spread between new multifamily deliveries compared to starts since 1975.
Wow!
So the starts are at a multi-decade low, and then but the new deliveries are still essentially coming off their peak.
And what's super interesting about it, because you'd think is it returning to mean? It's all a product of interest rates. I think.
Very largely. Yeah. The other piece of information, I think it was Jay Parsons that said this, is, and this has not been covered as much, RealPage, I guess, has made a couple notes on it, is that a lot of the new supply that's been started over the last couple of years there's a lot of affordable housing in that mix, in subsidized housing, because how have any development deals, ground up deals, been done? How can you make a pencil in the last 2 years?
Oh.
It's incentives from local municipalities and local governments, and typically for those subsidies and incentives, you're having to do some set asides. So it's not like, so I think there's like for 2025, like the rolling like the T12 or like the T12 of like under construction is like around 330,000 right now. There's a big chunk of that is either set aside. That's not all market rate. A lot of that is subsidized, set aside. And there hasn't really been a study. I need to look up this RealPage piece. But so like we're looking at, maybe 330,000. But again, the market rate could be well under 300,000.
Yeah.
And that number, that's what's like currently under construction right now. After we delivered, more than 500,000 in 2024. Starts are still falling off, and if there's still any new development right now, again, there's still incentives, there's affordable set asides, and so like how much actual market, which all that is good, that's all really good stuff, but we're typically used to looking at that number and assuming it's almost all market rate.
Yeah.
And that may not be the case, which affects those numbers also.
Wow. So, and that's something that I've seen in the new mark report too, is they put a chart down and the fall off in apartment construction is almost maybe even steeper than the jump and spike in apartment construction, which was, the most we've ever built in like 75 years or something like that.
So the supply of the new deals are coming down. Another piece that, again, with this tariff talk, again, we don't know how many tariffs will be real, how many will be just negotiating tactics, how many will stick around, how many will be here forever. Yeah. We don't know the answer to those questions. None of it makes it cheaper to build apartments. That's where I just keep coming back to is, the price. Is that going to make things more expensive or cheaper?
Yeah.
And cheaper is just not in the cards. I was having a tour with driving around town with a developer yesterday, looking at some of their deals, and he mentioned that there's only been 1 year, I guess, since they've been recording construction cost for multifamily, but I think larger construction industry, but specifically multifamily. 1 year where costs came down. That was 2010, kind of post GFC. The prices aren't going down.
Yeah.
It's not getting cheaper to build this stuff.
Yeah.
And here's back to the psychology. He's already getting calls from his suppliers saying, like, we're anticipating the tariffs. Get your orders in now.
What do you think they're going to do?
They're not lowering their prices.
Yeah.
I'll tell you that much.
Well, and
they're like, we got to get in front of it. We got to get the prices up now. You got to order now. The switches, the electrical switches, there was in COVID, there was a 24-month backlog. You can't turn your building on until you get the switch.
Yeah.
I'm talking a big switch. I'm not talking a light switch.
Yeah.
Now, we're not expecting those types of COVID-related manufacturing delays and things like that, but
that's the price of uncertainty, more or less.
The price of uncertainty.
And he wants that certainty of getting it, so you pay more, so that you have that on hand. And that's kind of what I'm getting at a little bit, is like, wow, there is a cost for making these dramatic moves and stuff, and we'll see how that shakes out. But again, like, to return to the fundamentals, we do know for sure that they're not building as much as they were before, and I think that's probably the biggest driver of rent growth, or will be, moving into 2025, 2026. They make a show of talking about how high home prices have also driven up the rent, and so does Newmark in their report too. I just think that it's easier to look at housing demand as a whole, and rather than trying to parse out which of the housing demand softness means, housing prices go down. Does that mean that they're pouring into rents? I just don't. Yeah, I'd like to think of how, household formation maybe, but not those kind of things. But in the end, like their focus on on rent increases and the burden that they represent, I think is important perspective to acknowledge. And really, like, this is what articles, like, we talked about all these issues, right? And yes, it's a nice excuse to talk about stuff we've covered over and over again, and like and talk about how, you know, we knew this before, you know, Wall Street Journal, which is fine. I think most industry people.
Well, I think we're supposed to.
yeah, exactly. But also, you know, this is a good reminder that the audience that they're aiming for, you know, they're spending a little bit of ink or digital ink or whatever. They're talking about renters' perspectives. High rents are going to get pushback. High rents, the rent rises that happened 2 to 3 years ago. People haven't forgotten about that, and so I think that that it's not necessarily like a counter.
Some
to
markets
it,
people are
but,
getting some good deals though. Some people are also remembering. They're like, I've heard just some stories in Austin where some people are like, I just got a deal.
Yeah, and that's another thing too is positive rent growth. They talk about, oh man, you know, there could be positive rent growth this year in Wall Street Journal, as though like rent growth really it usually grows every year. That's if it's 0.5% or 3%, then that's what that's really worth mentioning. But I still think that the whole upshot of this is that, you know, we're going to see more demand, and I don't think that it's going to be dramatic. I think it's going to be regional, though. And it's going to matter whether you're in Austin or whether you're in the Midwest or whether you're in some of these coastal markets that they've brought up. And we'll see a lot of divergence because the market is moving in different directions due to construction patterns. Construction patterns are different in every different city, so we'll see some different. I'm kind of excited to see what happens with the market now, if the Sun Belt continues or kind of breaks through again, or
it sounds like, you know, again the calls are, you know by the end of 2025, you know, maybe not strong growth, but at least positive in a lot of the Sun Belt markets. Maybe not full recovery across the board. Now again. 0%, you know, flat rent growth this year, you know, is after, you know, negative, you know, 8% rent growth last year, and, you know, a little bit negative the year before. So still significantly off the peak. It was just like when they said, you know, like, oh, San Francisco is crushing it in rents. It's like they have been lowering their rents for the last 3 years, and it's been a dumpster fire just because they had one positive month. Yeah, it's like, they were brought down to 0, and now they're, you know, getting back up. It is
crazy.
Good. I'm glad that they're not slipping, but it's because they're at the bottom. But the reasons they're not looking at the full graph.
Yeah, I remember when we started tracking that, it was like, man, Seattle and San Francisco. It was
in Minneapolis.
Yeah, their rent growth was always
catch
very
a
low.
break.
But,
it was for a variety of reasons.
Yeah. If you do want to move, just to kind of continue this discussion of the relationship between housing demand and apartment fundamentals, Newmark's report, it really leads with that. And I've been referencing it enough. I figured we could just dive in. A lot of great graphs that show the relative strength and maybe some of the weaknesses, I think, in the for sale home market. They talk about shelter costs increasing 4.4%, and I think that it.
You want to read some? Just go through some of their market observations, and I hate like reading it, but they always make really good observations. You know, I can I'll paraphrase. But so demand. This is what we're talking about. Getting back to the fundamentals. Demand rose to 230,000 in the fourth quarter of 2024. Rolling demand climbed to 666,000, making the second highest level in 25 years. Highest level of demand in 25 years. 487,000 units are expected to be absorbed through 2025. That's a lot of units. Yeah. Potentially the third largest annual total on record. Demand relative to supply, not net demand, but relative to supply was strongest in San Francisco and the Midwest.
There you go.
A total of 155,000 units were delivered during the fourth quarter of 2024. Reflecting a 3.2% decline from its record high in the third quarter. Deliveries. Yep. The deliveries are projected to decelerate further with a more significant slowdown anticipated this year and next. Saying markets already peaked in supply are likely to recover more quickly, which makes a lot of sense. Vacancy rate has declined a little bit. Sales volume totaled $45.5 billion in the fourth quarter. representing a 64% increase year over year. So again, that's base effect. It's still relatively low volumes, but doing much better than we did in 23. Despite subdued overall deal activity, large portfolio and entity level transactions emerged throughout the year. Multifamily remains the top capital recipient in U.S. commercial real estate, comprising 34% of the trades. Here's Matt, we've been covering this a lot. Approximately $770 billion in multifamily loans are set to mature between this year and 27. Banks hold 24% of that debt maturing from 25 to 2033, but 42% of the near-term maturities from 2025 to 27. Debt fund maturities are front-loaded, accounting for 21% in near-term versus 12% overall. GSEs, which is agencies, Fannie and Freddie, they're pretty much backloaded because they're longer-term debts. This, I think, could, the loan maturities, still, that's the strongest candidate for a catalyst for some sales volume and some really any kind of major capital market activity near the end of the year. Fund vehicles targeting the U.S. or North American commercial real estate launched between 22 and 24 have accumulated $274 billion in assets under management, of which 78 billion of that, or 71%, has yet to be deployed. So there's a lot of dry powder ready to go. Dry powder in these funds could drive greater deal flow in 2025, but they got to find the deals.
I know. That's why the powder's not that dry.
I
think I made this joke before, put it in the notes for previous weeks. It's like they haven't. It seems like we're always facing a huge record amount of dry powder, and dry powder's waiting for this perfect deal. It's like, geez, can I get anything to spark this activity? No, it's because powder's wet. It's not so dry.
Yeah, it's moist. It's like
yeah.
I'm trying to think of another good analogy. I don't have one. As of the fourth quarter, the average 30-year fixed mortgage rate in the United States was 69.8% higher than the effective interest rate on outstanding mortgage debt. This significant spread dampens the likelihood of a large recovery in home sales until the gap narrows. Existing home sales drop at just 4.1 million units in 2024, so it's cheaper to rent than to buy. Whew. Matt, strategy recommendations.
Yeah, well, that's what their kind of takeaway is for the big first part of this is home buyers not active. It's a slump in home buying activity that we've actually tracked in previous episodes of the Gray Report. It's not exactly worrying. It's not an emergency yet, but it is a little bit like I don't like to see it. I don't think that the loss, that single-family home sales' loss is apartment rents gain. I don't think it works like that. So we'll have to see how the relationship works out.
I think you're 90% of the time that's correct. I think it begs the question though of like, is in like an extreme example of extreme unaffordability. It's crossed that threshold.
And the Real Page article fills in the blanks. I think a little bit better than this, but they use a lot of the same terminology. The rent to income versus like home buying cost to income. The rent to income has not been growing like the other one. So it's still, that's the real.
Well, and there's still positive home price appreciation. It's not as though it's like the single family home industry has been devastated and the prices are falling out. No one wants them. No one can buy them. There are enough buyers to meet the market price. Just on low volume. But just that volume has shifted over to the rental space, and so they're still both positive. And so what you're saying is true, and it's true despite the logic of thinking of like, who can afford to buy a single family home right now? Who's doing it? But clearly there's so much housing demand, which is your point, is that people are still buying single-family homes, people are still building single-family homes, and they're renting. It's just, a lot more renters.
Yeah, it is weird. And so we can scroll through. There's some really good graphs here. So renting is more cost-effective.
Expensive.
Yeah.
Just like compared to the average, my God.
This is the cost of home ownership compared to renting, and it looks like it's 1,120. So the total median monthly payment for home ownership and the average effective rent for apartments reached 1,120 as of the fourth quarter, a 1.6 year-over-year decline. Despite this narrowing, the spread has remained above the long-term average of $416. So it's better to look at that the long-term average. So this is the spread. This isn't just how much it costs per month. This is the full difference, and the fact that it's teetered down a little bit belies the huge spike upward that we saw really since third quarter of 2022, and that's when home prices really took off, and they really haven't come down from it. We are over we're nearly 4 times the historical average, or 3 times. 3 times. We're nearly 3 times. That's still a lot. The historical average when we're talking about the price. Yeah. It's crazy.
Yeah.
But I still.
That's where I say it's like, okay, I agree, but it's so extreme of where.
Yeah. But I do a little bit makes me think. Well, if we're talking square footage, and there are other measures of where we're talking about renting and owning of like the same home and similar ones, they still show this increase.
Yeah. Whether it's 2 times more, 3 times more, 2.5, it's more expensive to own than rent. Yeah, for sure. It's really clear. And we'll reach out to Newmark for our needs. Would-be buyers on the sidelines. Purchase applications remain weak.
Yeah, so this is like they're not buying anymore. This is the one that it is a little bit worrying. Like, sure, home prices have gone up maybe 3-ish or so %, but maybe on a month-to-month they're not. They're getting a little softer, and I've heard some predictions that like we could get into negative territory for annual increases. No one's talking about things like dropping off a cliff. They're framing their argument as like, hey, prices may go down, so why don't you go get in there and buy? That's like the articles. So it's not crisis level. I still think the fact that we are buying and selling as much homes. So I'm trying to trace this chart back as like in 1994. Is that?
Yeah.
And this is
similarly between like 2010 and 2014, we're back to the 90s.
Yeah. Crazy.
Yeah. And then it's like, just on the single family home space, it's, when will the boomers move out of their large, 4-bedroom single family homes?
Yeah, they talk about millennials doing that too on page 10. They've got really great variety of graphs here. We can go through all of them, but it's they all illustrate the difficulties of home ownership, and they really do kind of explain why the home sales has gone off, because it's getting pretty expensive. On page 10 they look at millennial move outs as a metric, and I just think that I don't know if all of these tie into their logic, but I think that the collective thrust of all of their argument here is it's pretty persuasive. I'm thinking, they got to go somewhere. You're going to probably rent if you're not buying, but I'm just looking for a paper that really isolates that and kind of, I don't know, in a little bit more specificity about that relationship between apartment renting and apartment buying. But that's neither here nor there. I've been asking for that for way too long, I think. If you want to move on to apartments specifically, on page 13, really shows how much demand there is. Basically off the charts, it looks like. Now, it's not quite the peak that we saw in when rent growth was growing like crazy, but it is really close to it. And right now we're looking at apartment demand quarterly and annual numbers. You see the annual numbers as this huge spike, but I also think it's worth mentioning the quarterly numbers and how for the past 5 quarters, apartment demand has gone up. It's not like it peaked in the summer and then went down in the winter. This past winter, it was more than the previous quarter.
Yeah, and I'm tracking that anecdotally on our portfolio. I've been very pleasantly surprised as we've gone into this winter of where it's usually like the slowest time of the year for a variety of reasons. But we've been signing leases. Yeah, like it's August.
That's great.
We've had like NOIs like they were last August in some properties, and we're just in like the pre-season right now.
Yeah.
People, it really kind of gets going to March, and so then you have typically we're having a lot of conversations, and we are about March move-ins, and we'll have leases expiring in March, and so they're trying to get ahead of it now. Which again, the apartment industry, it's interesting because like the way you sign leases, typically how most operators work, like you can't lease something that's like 2 months out. You can like be maybe put on a wait list for something, but they don't want to take a unit offline for months in advance. It's like if you want to plan, like let's say like 5 months out, like I'm going to move somewhere, like you can't rent an apartment.
Yeah, that's crazy. Well, but they know. Well, but I guess if you're renewing, they don't know if someone's gonna.
They don't know if someone's gonna renew.
Yeah.
They don't want to. What if someone wants to? What if someone wants to move in next week?
How soon do you have to tell someone that you're renewing?
I mean, the notice goes out usually 90 days prior to your lease expiring.
Okay.
And then, so you try to get them as soon as possible.
Yeah.
I mean, there's typically, and if you've got someone wanting to move into that unit.
Yeah.
Yeah,
it is, and that explains it. But like it's so much of a fluid market for renters, and and for landlords too. And you kind of watch things day to day. It's crazy how much things change.
Yeah.
So that's demand. It's going great. The fact that it's growing quarter after quarter is a great sign that probably this demand will continue. But if you want to skip down, we could talk about loan maturities or some regional information that they have too.
And why are we seeing such strong demand? I mean, help me understand.
Well, I think that
they have a household formation.
Yeah.
Strong new household formation reinforces housing demand. So, okay, inception. What's causing the strong household formation?
Yeah, well, and I always felt like household formation is a little bit of a combo between job growth and population growth, but it's, when 4 roommates decide they want to get their own places, then we got a household formation of 3. That's kind of more or less. It's like when you're in that position where you're able to form a new household, and that's.
And so they're saying up here one. I don't think this is it, but like the millennial move outs, which like we all know people who have like lived with their parents until recently, and I mean surprisingly like 18% of millennials, probably all men, were living at home. Not all men, but I'm just saying.
Not all men.
In 2020, 18%, a fifth of all able-bodied millennial men were people who were living at home with their parents, not roommates, but with their parents, and that's down to 16%. So what they're basically saying is these guys are slowly getting a job or moving out of the basement. Well, maybe they already had a job, but I mean, like
it's just like an anecdotal detail. I don't think there's anything can stand on that. But
no, I know, but but that's a lot of people.
Yeah,
that's a lot of people who traditionally would have gone on and gotten a place. I mean, for a variety of reasons. I mean, we all know how hard it was to get a job for millennials when you're getting out of school. I mean, your brother. I mean, he was living at your parents' house for a long time, working. But it made sense because he was like saving money on. It's like, look, I'm saving all this money.
Oh yeah,
I've got a place. Like this makes economic sense right now.
Yeah.
The boomers have all this bedrooms, so it makes a lot of sense. And in probably other parts of the world, it's like, all the families living together. That's how it should be. But in America, you like to be out and be independent and do our own thing.
Yeah.
And this is atypical from prior generations. I mean, I'm just what else?
So this is actually interesting too. They say that, and I think this gets really close to the relationship between can I buy a home or can I rent? REIT data shows a record low 8.6% of tenant move-outs were due to home purchases. So fewer people are moving out because they're buying a home because they can't because it's more expensive. So maybe high home prices serve to kind of keep people renters, and maybe instead of like, it's not like you face a decision, do I buy or do I rent? It's like an ongoing thing that.
And that's really positive for A-class developments because one of the primary reasons why we have move outs or the reason for move when we ask why are you moving out, and A-class properties, one of the most common reasons is buying a home. You don't see that in workforce housing nearly as much, but it's very common. Buying a home. It could even be 50%. So this number basically is cut in half from 16% of move outs to buy to 8.6. That's a lot of folks that are staying in those A-class apartments longer.
Yeah. So these are all positive, and it may very well be, kind of connecting the dots between what's happening in with high home purchasing prices and rental demand. But regardless of all of that, it is undeniable that we have high rental demand. I do think that there are maybe demographic things. Maybe it's, wherever millennials are moving or Gen Z's growing or, it's a combination of job growth, of demographic growth and demographic trends and, and home prices. There's basic supply and demand, I think. So that's overly general, but still, they're writing Wall Street journals about it, so I feel like I can touch on that.
Yeah, why not?
Yeah.
Anything else on this report? It's a great report,
so
and I'll just say, if you want to get these reports delivered right to your inbox, capitalllc.com/newsletter. We got a bi-weekly newsletter that basically aggregates all the most important data in the multifamily industry. It's like the best multifamily newsletter on the market right now.
Oh, yeah.
So, what else on this new market report,
Matt? I want to skip all the way to page 32 here. This is a 58-page report. And
we don't have to look at this. Any of these scatter plots.
There's some great scatter. Yeah, great scatter plots of different markets. Similar, upshot of this is some coastal markets are doing good. Midwest is doing great. So let's just put a pin in them. But on page 32, they talk about loan maturities and upcoming maturities heavily exposed to bubble era loans. This is the story that we were saying.
I haven't heard bubble yet. It's the first time I've seen bubble in a publication.
Yeah, but it kind of felt like it. When everyone was super active, we were like, "Can this last?"
Yeah, 100%.
Like those weird YouTube videos of people blowing up the balloon. We felt that.
Peaks are observed bubble activity. I mean, we'll close in 30 days, no due diligence, millions of hard money day one without ever taking a look at the property, just the opportunity to win it. And because we're going to forecast 20% rent growth for 3 years, we're going to buy in a floating rate bridge. Yeah, there was definitely seemed like a bubble at the time.
Yeah.
Oh, that's why we didn't buy that many properties during that time.
Yeah.
Slowed our roll.
Yeah. Well, and
wonder why we aren't issuing capital calls, man.
But if we did, that would have been an exciting 2 years. Wouldn't it? We would have felt so happy for those 2 years. But be a little bit of a hard truth.
Fortunately, cooler heads prevailed.
So, talking about maturities, we're talking about the high spirits and maybe the low spirits now. I do want to mention in 2023 there was we saw a on paper there was a bunch of CMBS loan maturities and by extension larger amount of these bridge loan maturities that were coming due in October 2023, and that passed. It was like no, because
the can got kicked down the road.
Yeah,
we put out a whole research brief because we were like, is anyone else looking at this? Like, does anyone see this wall of what's going to happen here? We know the values are upside down, and the can got kicked down the road. The can got kicked down the road because the idea was that interest rates were going to be lower in a year or two, and a year or two went by, and
people noticed. There was when we did the report.
It got picked up by
it got picked up.
It got picked up. By
it was in a discussion cycle. Whether us contributing and other sources were talking about these loan maturities, but it seemed like it was quickly forgotten.
Well, forgotten. Then people were like, "Hey," people were almost saying that we were alarmed, even though if you look at all of our research, it was really clear of here's a couple different paths.
Yeah.
These could get extended, pretended, pocket. Anyway, it was very nuanced report. It was not disaster.
Yeah.
And but people were like, hey, I mean, prices did go down 20 to 30%.
Yeah.
So it's related to a couple different factors, and that was one of the calls of could lead most likely to pricing declines. But people were like, well, I haven't seen distress across the entire market, so what to do about nothing.
So it was under the assumption you said all these loans were coming due and no one was going to be able to pay for them. Well, guess what? Nothing bad happened in 2023. So nothing bad's going to happen in 2025 is the assumption.
Yeah, well, I think that's the scary assumption is that everyone's like, we've heard it once, I've heard it twice, cried wolf once or twice, and it's like, well, the wolf actually may have been there just because it didn't kill the sheep, definitely saw the wolf. It just exists.
And were the capital calls, again,
the capital calls, there have been foreclosures, CMBS delinquency, in general, multifamily loan delinquency is at, now, again, it's still very relatively low compared to the GFC, but in the last couple of months, do you have any?
Not that, but I do remember, I do know what you're talking about, and it may be in the Newmark report.
It's spiking.
It is trending upward. It's unmistakable.
Again, we saw the offering on preferred equity deal to save, some of their own deals in that, which is whatever. But that's a sign of all of this. There's obviously a conversation that the bill has to be paid. It has to be right sized, and the only way to do that is to bring some money into the system.
How does a preferred equity differ? If you're calling a preferred equity opens up the investment to other people, that's what's different from a capital call?
Well, no, not necessarily. Preferred equity is talking about, it's really more of a form like mezzanine debt.
You're getting paid before.
Yeah. So the preferred equity is basically, it's between the equity and the senior debt holder. So, in order of
the
who
senior
gets paid
debt's
first, the mortgage.
Okay.
So you buy a property with a loan, you get a mortgage to buy the property. When you sell it, the first person that gets paid is the bank, and then the next people to get paid are the equity or the common equity. And that's sometimes split with the GP or the sponsor. But with preferred equity, it goes to the bank, and then preferred equity gets paid, and then the common equity. Really, common equity and then the GP split.
Do sometimes preferred equity get higher? Do they say we'll pay you a higher pref or something like that? Or
so the advantage, the attractiveness of preferred equity is that it typically comes with a higher overall coupon than you're going to get on a loan. And what is attractive is that the total coupon or preferred return can look pretty close to common equity returns. And so if you're looking at a common equity, let's say 15%, total return for the common equity, if a preferred equity deal has a 12% preferred return or preferred return / total return, because there's no upside typically on preferred equity. So it's you're going to get your 12%, maybe not at the same time, but 12 versus 15, that's only 300 basis points, but I get paid back first in the pref equity, so the risk is lower. Because I got to get all that money paid back before the common equity gets a penny.
And I'm kind of thinking,
why take the extra risk to get the 15 when I could just get the 12? But here's the thing, and I'm going to answer the question of is it the same and is it better?
I'm just putting myself in the investor shoes a little bit here too.
Well, we should talk through it. So the pref, because it's how do you pay a 12 pref? Usually it's only representing 10 to 20% of the overall capital stack. So it's not 12% on all the equity or all the debt.
Yeah.
But it's also, there's a kind of a current pay and a total pay. So oftentimes you're not getting the full 12%. You're getting anywhere from 0 to, could be 12, but usually 0 to 8.
Okay.
Maybe 10. Call it 0 to 10. So on a development deal, a lot of development deals are being done with pref equity, in which sometimes that interest reserve is funded along with the common equity to pay the preferred return. But oftentimes there's 0 current pay. That 12% preferred return just accrues to the end of the deal.
Okay.
So it's they're accruing that 12%, but it's never actually being paid.
Yeah.
Here's where it you run into trouble is all of a sudden you look to sell it, and this is the case in quite a few development deals that I have seen, is that the value of the new development today is worth about the same as the senior mortgage. So the preferred return or the pref equity, you think you're taking low risk. People think it's a sure thing. There's still risk in it. Yeah. And the deals that need pref are often the riskier, skinnier deals that they've had to stretch and they've needed pref. I'm not saying that across the board. I'm just saying oftentimes it's a skinny deal. You can't convince the common equity to come on board, so you can convince some preferred equity investor to be hey, you're going to take a little bit low risk, but you're going to get really nice equity-like returns. So, in the case of capital call versus pref equity, so I have a deal. It's a little bit underwater or whatever. I've got a loan maturity coming up, and my bridge loan, it's 2 or 3 years. It's coming due. I've got to either sell it or refinance. The lender's you got to pay us back. Don't care how you do it.
Yeah.
You can sell it, give us that money. You can refinance it and give us the money you get from that and whatever else that we're owed. And so they're like, okay, well, we don't want to sell the property right now because, well, we've got a $10 million loan on it and it's only worth $9 million. So
Yeah.
we would lose $1 million. But we've got 15 million in it with our equity. Mm-hmm. And so they're like, well, we're going to refinance it we're going to refinance it. The new loan that we're going to get, since it's only valued now at $9 million, let's say that the new loan's only going to be for, and I'm going to be very generous, is going to be $6 million. Mm-hmm. All right. So then they've got to bridge that gap of the $4 million to pay back the first lender.
Yeah.
Because the new lenders, we're only going to give you 6. Mm-hmm. Well, the original lenders, like, we're owed a 10 total. And so it forged a $4 million gap. So you can so there's 2 options. You go to your investors. Well, there's really 3. One, just the sponsor puts the money, digs into their own pocket, mm-hmm. and they write a $4 million check, and they just put it in the deal, and they make it subordinate to their equity, as in their equity gets paid, and then they'll get their $4 million at the end of the deal. They screwed up, miscalculated, whatever. Nice thing to do. Not everyone has $4 million just in the back pocket, especially if you've got a bunch of deals. So you either say, hey, we're going to issue a capital call to our investors mm-hmm. and say, we want you all to invest again. We need more money. Otherwise, we might lose the deal. Yeah. And your investment will be lost. We need $4 additional million. We know you already put in 5. This will dilute you basically, by, what's 40%, or significantly. Mm-hmm. But, it's better than going to 0. Because we're gonna have to, we're gonna hand the keys back, and your investment's going to 0 if you don't do that. So that's option 1. An investor has to ask themselves, though, if I do that, can we actually sell it and make money? Will I ever get my money back? That's what we were talking about earlier. So the other option is preferred equity. So the sponsor's like, well, instead of like bugging because capital call is bad, mm-hmm. And they're not. Sometimes it's a reality. What has to be done. Yeah. There are great sponsors that have issued capital calls. They're issuing capital calls today and have issued capital calls in the past for really good reasons, on really good deals, mm-hmm. and they save the deal. There are other times where it's like, we screwed this deal up. There's no saving it. I don't want to admit defeat. I'm going to go ask my LPs for more money just so I can try to give myself another chance. There's no real plan. There's really, everything has to go right to even break even or to get your money back. Yeah. You really have to ask yourself, is it worth making that capital call? So maybe that sponsor doesn't want to just even broach that topic. Mm-hmm. They don't want to have to call all of their LPs and say, will you give me more money after the property's not been performing well? Yeah. Because most often the investors aren't obligated to meet the capital call. If they don't meet the capital call, they'll be diluted. Yeah. But they're being diluted either way. Yeah. And, again, it's a sinking ship. Is it worth focusing mm-hmm. on the sinking mm-hmm. ship? So the preferred equity comes in, and it's basically, hey, it potentially eliminates the need for a capital call. And so you could offer this to investors. You could offer it to outside new investors, existing investors or new investors. Mm-hmm. You also could do a member loan, which is, instead of like preferred equity, it's essentially you're offering a subordinate to the first mortgage, but from members of the LLC, your LPs. Often there's a member loan provision where they can provide a loan to the deal for like a predetermined interest rate of usually it's like the preferred return, 7 or 8%. And that's not technically not a capital call, because it's not dilutive. It's just a loan that the members are issuing it that will be paid back with that interest whenever it can be done. Mm-hmm. That is an option also. But you're still having to go back to your LPs and asking for money. Yeah. So to avoid all that, some sponsors are like, I'm going to go pref equity, which is really, just think of it as debt. You're sacking, it's subordinate to the first mortgage. But again, these rates, the total pays on them can be anywhere from between 12 and 16%. You're paying a 12 to 16% interest rate on that money. Yeah. So that sounds good for an investor to be like 12, 16%, like all day long. Yeah. Again, it's the skinniest deals that need the pref equity. Yeah. So again, it's not guaranteed. Higher return is higher risk. Mm-hmm. There's some pref equity, it's clean, it makes sense. Yeah. But so what you're doing is and the catch is that money gets paid before your investors. So you've raised money from investors. Then you're raising money from new investors. Those new investors are going to get paid first. your old investors may not get paid at all.
Yep.
And there's no guarantee that anybody makes any money. So, so that's the difference between capital call and preferred equity. And I think the best way to do it is to do it internally. Like, hey, investors, like we want to save our own deal, but it's being these deals are now being marketed as like new opportunities to invest in an existing stable portfolio somehow that is so stable that it needs preferred equity.
Would you say, in general, I know everything's different, that going for preferred equity means like the problem may be a little bit bigger than if you had a capital call?
Not necessarily. Okay. I think it's a strategic decision.
Yeah. Well, either way,
and again, not all deals that need pref are bad deals.
Yeah.
But it all deserves scrutiny. There's a lot of nuance in it. If you've got a deal, I'd love to talk to some more people who are willing to talk openly about their capital calls. Yeah. If you're going through a capital call, sponsor or LP, can I shoot you an email, Matt at greatcapitalllc.com. I'd just love to get your perspective. And we talk to folks all the time. I could ask some of our investors who are with other sponsors. Might do that too, but I don't know if you're watching this and you're like, I'm in a bunch of deals. Like, let me talk about this. I don't like to speak negatively about folks in the industry, and we could be naming names and dropping names.
Oftentimes, it's just a sliver between really successful and then really not successful.
Yeah, no, and I see groups again, kind of group that I'm talking about right now that seem like they do a lot of things not the way necessarily that I would do it, but they're doing a lot of things really well in the way in many cases, and have like sophisticated organization, at least for the optics. I don't think they've done anything wrong or even no one thought interest rates would move as quickly as they did. Some people thought that they might move more than others, and different decisions were made. And I hope that when folks are looking at different sponsors out there, they're like, oh, Great Capital made the decision to not use bridge loans and took a conservative approach during a high risk time versus another group that only uses bridge loans and ramped things up during a super high risk time. And so it allows us to contrast the two, because in a market where it's like all the deals sort of like the same, they're all multifamily cash flow, the terms are all the same, even though they're all different. It can almost seem like a commodity. But it's, in a rising tide environment, it's hard to differentiate between the good, the mediocre, and the bad. And we've had an interesting period here. And so again, if I wouldn't be doing my job as CEO of the company and being like, look, we did some things right. We're not perfect by any means, but contrast that against the benchmark for the rest of the industry. So where we want to go next?
We can touch on some of the more uncertain things. So, loan maturities.
We've given everybody a foundation of certainty. Right now, we're going to tear it all down.
I had a flip flop, but I think that I was more excited about talking about the real strengths in the multifamily market. And we did end on talking about the idea of distress and loan maturities, but that is not the result of current fundamentals. That's the result of things that happened 2 years ago and all the intricacies that we have just discussed. That being said, it could be an interesting investment opportunity. Some of these loan maturities, maybe we have right now delinquencies on the screen and showing the jump that you kind of signaled here, and we'll have to see see how that shakes out.
So in this chart, there's $51 billion of multifamily loans that are past their maturity date that are still outstanding. That's a lot. It's not like, the multifamily market's like $1 trillion+ market, I think.
Wow.
I think multifamily's like $1 trillion total market cap ish.
Yeah.
So 51 billion out of $1 trillion. That's 5%. Right.
The fact that out of that 51.
That's right, 5%.
Yeah. Wait, 50 out of 200.
No, out of not out of 200, out of a trillion.
Oh, I don't know that. I don't know that math yet. I'll have to carry the zero. I'm not. But yeah, it's
that's like it's a sizable amount, but it's not like it's not 50%.
Yeah.
But
if you're looking at the breakdown of multifamily maturity still outstanding,
Yeah, not troubled extension options.
20.4 of 51.3 is delinquent. There's some that are on the watch list and some that are not troubled. Oh, I'm sorry.
No. 20.4 are not troubled extension options.
You're right.
Why is it? I guess why is it past its maturity? But maybe it's like, hey,
So
look, we'd rather we want to give ourselves a better time, maybe get a better rate before we put permanent financing in place.
Yeah.
So so if you take that out, so that's that's 20. So we're looking at like 3% of multifamily, rough math. That is past its maturity date and either in special servicing, watch list, or it's delinquent. That to me, I mean, that again, that's not good. That's not good, but it's not something that's going to wipe the market out.
Yeah,
Again, it's exactly what we've been calling for: is this pocketed distress. And like the vast majority of these, I don't have the statistics in front of me, but the vast majority of these are older, B, C, D class value add deals.
Really going to be interested in seeing how this, if this
and
inspires
some
more
new construction.
Yeah. Some new? Okay.
Well, the development deals,
Yeah.
the new development that is with a construction loan, they haven't yet taken out to perm.
Okay. Yeah. Hopefully this will kind of spark some more sales activity. And that is one of the things that's been tracked in some of the other reporting and stuff from this week is they're slowly growing sales activity. It's not like it's growing crazy, but it's slowly going up.
Yeah, and I don't think that's enough. Yeah, and I don't think that this is enough volume to like move prices down significantly.
Yeah.
I think that people are gonna. There's buyers for these older deals. There's not nearly as many, but there are still buyers. And if the pricing gets like halfway attractive, they're going to get scooped up. So I just don't think we're going to get to like fire sale prices. They're not at a market clearing price yet.
Yeah.
A lot of them, and some of them probably have yet to hit the market. But it's not. I just at that level, I just don't see it being systemic, like across the industry to bring like cap rates up, prices down. Across the board, it just the volume isn't sufficient.
Well, and this is one of the things I was thinking about too is the idea of momentum and is how much momentum and how much is it stagnation? Because there is low sales volume, but they're slowly creeping up. And is that going to increase or not? Because NAHB had these multifamily developer, like their sentiment is that like basically things are going to stay the same. Basically, their whole feelings was the same at Q4 2024 and Q4 2023. Yeah. So not really much change.
No, I agree. No, now it's less like survive till 25 or whatever. Something in 26. It's the narrative now is, which is like part of our original general investment thesis, is the ability to withstand long periods of time. is the only way to success. And they're like, look, in the great financial crisis, those deals sucked. If you could hold on to them, all was made. Like time and money solves all problems. Yeah. And if you have the time, you could have problems right now, but you have time on your side. Like you really need time and money. But if you've got time, especially the market will work itself out given enough time. Your short-term issues all can be solved with money. Yep. So again, not tooting our own horn, but like principle, just the way we've looked at deals is overcapitalize the deals, put more money in them than you really need. It drags down returns a little bit, but I've been in enough situations where it's like, I'm glad I got that extra $100,000 in the reserve account or $500 or $1 million. It seems like a lot, but shit happens. Yeah. And it's, again, risk equals return. And then time. Be prepared to hold it for a long period of time because you don't know what the economy could crash next year. So if you have to do something in 2 years when the economy is recovering, you're selling into a horrible environment. Yep. Give yourself the runway to have optionality of when you can choose the exit of if you're choosing, not let the bank decide for you when to sell. Yeah. Screw the banks.
And I think that there was a lot of assumptions, and this is what at the beginning of last year.
I love our lenders, by the way.
At the beginning of last year, maybe people were, people didn't know what to expect, but there does seem to be like things are going to return to normal soon. Things are going to go back to normal, and the assumption is back to normal means improving from where it is. And I think that one big difference is now people understand, oh wow, maybe we're in it for the long haul. The long-term decisions,
100%,
yeah, whatever it is, whatever it is.
And I'm just like, welcome to the show.
Yeah,
this is real estate is a long-term thing. Yeah. Like this whole get rich quick. I'm going to go and do a quick flip. Does that happen? 100%. Props to the guys who do it. But like the long-term play is the path to success every single time.
Yeah.
And if you haven't figured that out, like trying to get up to speed, you have to give yourselves time. True. Velocity of money, deal, deal, deal. If you can 2x in 3 years, or it's really simple, 2x over 5 years versus 3x over 10. Okay, well then why not 2x in 5 years twice? So you 4x over 10 years rather than the 3x. The velocity of money makes sense.
Yep.
Shorter hold periods, higher rate of return. You grow money really quickly. You recycle it, recycle it. There's risk every time you recycle it. In and out, in and out. There's transaction costs, but there's also just risk and execution risk and timing risk. So again, if you're young, you've got the time. Yeah, go in, crank out, get a high velocity of money, flip some deals, make some big checks, and then put it away for the long term. If you're interested in preserving your wealth or generating some income and then multiplying it by a reasonable amount, then you set yourself up for a longer term hold, because like most real estate investors who are looking at stabilized multifamily, they're looking for a balance between safety, cash flow, wealth generation, and some tax benefits to boot.
Yeah.
That's it.
Yeah, that's a good case for the inherent benefits of multifamily and the kind of abnormal way that the multifamily was working like a couple years ago. That's cause and effect right here. Is so there's a lot of risk there, and might as well just lean into what's good about this investment class.
I agree. Yeah, I've just spent a lot of time with some old time real estate investors. They're just old school, and then it's like, this is how you make money. This is how you've seen people make money.
Yeah.
This is how you do it. It's nothing new. Real estate's not a new thing. There's more technology and there's different ways to look at it, but there's nothing really that's changed. And like, there's a clear path to success, and there's a clear path to small chance of a lot of success, but a higher probability of crashing and burning.
Yeah.
Or burnout.
Oh,
So
good point.
got anything else, man?
No,
on the docket?
I think we did really reference a lot of the uncertainties, and just kind of in passing as we went through the other topics. Yes, there's political things. I think that when just to touch on Trump may be defunding things or funding things, it does make predicting future different. It does make it difficult, and I don't think that's necessarily a good thing. But like I'm trying to focus on the present right now.
Yeah, and let's focus on the things we can control.
Yeah.
Like and not be aware of the externalities, but like just let's not worry about them so much. Just be aware of it and focus on what we can control and try to have a long-term vision. And it always seems scarier when you're in the middle of it. And just uncertainty just breeds nervousness and fear and indecision. And that is when incredible opportunities present themselves. Because other people can't get past themselves, and so they get stuck. And this is, I attribute a lot of the success that we've seen is because in COVID, we took certain actions that other people weren't, whether that was going to tour a property in person when everyone else was like, oh, we can't go out and do anything anywhere. Or it was when we purchased made offers, because we were like, we think people are still going to need a place to live even if they're sick. And I was like, the 10-year treasury is at 0.6%. Do you know what that means to valuations? It means they're really high. The value's going up. Maybe not forever. And we made that, and we did a lot of really good deals during that time. And I see this time period not the same, but similar as, again, don't know all the details. There's a lot of opportunity in the market right now. Not a lot of deals to do right now, but it's even more incentive to work that much harder to find the few that are out there. And then just to sum things up, Matt, we have one of those deals, walcotinvest.com. It's a great 2020 construction, 215 units, downtown Jeffersonville, Indiana. It's incredible. It's like an urban location, but it's a suburb of Louisville. So it's like right across the river, lower crime, lower taxes, walkability.
It's growing faster than Louisville.
It's like the second fastest growing like county in all of Indiana, which is, tons of great growth metrics all across Indiana. You look at the U-Haul reports, people are moving in, jobs are moving in. We're really excited about it. I'm bullish on the market, the property in general, multifamily in general. Is there uncertainty? Is there a risk? 100%. Are we speculating a little bit? 100%.
Yeah.
Are we conservative the way we're looking at it overall? Yeah, that's just like how that's in our blood, and that's how we operate. And just look at our track record.
Yeah.
But if you'd like to learn more, you got to be an accredited investor, thanks to the SEC. But love to talk to you. walcottinvest.com. Got a lot of information about it. So thanks, Matt. This is a really good episode.
It was fun.
Make sure if you're watching the video at this, you're an hour in. If you're not subscribed, like what are you doing here?
Tell your friends to subscribe.
Tell your friends to subscribe, and then you leave a comment being like, "I listened to the outro that only statistically a handful of people ever get to." So we could say anything we want right now in this moment, man.
I know. I think we need to hook that into some kind of like T-shirt giveaway or something.
Oh, yeah. Okay. T-shirt giveaway.
Yeah. So
how do they get the T-shirt?
Well, I've got to think of it. Maybe like some kind of
We
game.
can do it right now.
Yeah.
Doesn't matter.
All right.
Well, no. If someone's listened to this far in and they take the time, can they just email you?
Yeah, email me.
Matt@greatcapitalllc.com.
First person that asks, I will give you a T-shirt.
And even maybe a mystery box. It might be a T-shirt. It might be a mug. It might be. We've got all kind. We've got
free stuff.
We have cheese boards. I don't know if we have any of those left.
Oh, I think we do.
We've got some calculators.
Yeah.
First email is getting the cheese board and a T-shirt.
Here we go. Connect. Matt@greatcapitalllc.com. This is going to be fun on my email.
I don't think you're going to get any emails, but
yeah, hopefully.
Yeah. All right. Thanks, everybody.